panelists to come forward, please. And I'm going to introduce them as they come. Simon Bray is our first panelist. Where's John Roberts? John Roberts, could you please step up? I'm going to just, do you want to take a seat over there, Simon? You just walk around over there. Okay, so I'm going to read Simon's CV. He's a software designer, online marketer, and surfer. Yeah, you wouldn't say you're a surfer, eh? From Durban. He is now the CEO of Private Property. Private Property showcases sales, rental property from all of South Africa, including listings from thousands of countries, estate agents, private sellers, banks, and developers. Okay, so Simon joined Private Property in 2011, and he's also prepared the software, game software, Houser.com. He's a varied background, first studying mechanical engineering, followed by a degree in brands and marketing. So, wow, okay, well, welcome there. Put your hands together, Simon. Please group up as well. And Dolph, where's Dolph? Is Dolph run away? There's Dolph. But John Roberts on the left-hand side here, he's a director at MyRent. He used to be the CEO of Just Property Group, who has a very big property portfolio. So MyRent is a company specializes in underwriting rental guarantees on behalf of rental agencies and private landlords. It's been here for 4 years. Considered the #1 rental guarantee product. Okay, so gentlemen, we heard this morning, property is not sort of in the best place, but maybe let's take a little bit of a turn and turn the whole thing upside down. Maybe Simon, starting with you, give us a little bit of a feel of what the South African residential property environment is looking like. So let's look at sort of the home buying market. Can you describe some of the areas in South Africa that seem to be performing quite well? And give us some reasons why you think.
Yeah, well, thanks for having me, guys. It's great to be on such an esteemed panel.
Yes, yes.
Can you hear me better?
Yeah.
Yeah, so first of all, I must just add a disclaimer. I'm not a property expert by any means. We run one of the nation's biggest property websites, so we're in a unique position of being able to see the market kind of at a macro level, but I don't pretend to be on the same level as any of the esteemed panelists next to me. But what I can give you is just a bit of a view of what we see happening in the digital side of property marketing. And I think what was quite interesting is how many of your 101 best ideas are actually marketing related ideas. So, creating perception around what you sell is so important, and online we see that as well. Great photos often sell terrible properties. So when we look at the market in South Africa, we look at it from a marketing point of view. And it's interesting some of the things that are happening. A lot of growth in some areas, like massive growth in some areas, and I think that's what drives the positive perception around property in South Africa, even against that backdrop of quite a difficult economic time.
Which are those areas? And
yeah, for sure. So, look, I don't think that's the picture across the entire nation, but certainly if you look at the top performing areas, 6 of the top 10 across the nation are in the north of Johannesburg. So certainly in terms of some of the things we would look at are demand statistics. So we would match the amount of interest on properties on the website against the supply of properties in that particular market, and we get this factor of demand, real demand in the market. And so 6 of the top 10 suburbs are in the north of Johannesburg, so areas like Craigavon, Douglasdale, Sunningdale, so very much centered around Fourways, and Centurion a little bit further towards Pretoria. I mean, you mentioned Pretoria, or Nikki mentioned Pretoria earlier. Massive growth in that area, whether that's driven from the growth in public services and the growth in public jobs, or whether there's just good value in that area, I'm not quite sure. But we're definitely seeing, as a trend, those areas that offer great value opportunities in that kind of mid-level property bracket are the ones that are performing
best. What is that level? Give us a number. What number is between them?
Well, as a property website, our average property value is actually quite low because we represent all of the property in the market. So 60% of the properties on private property are around $1 million. So when we talk mid-level, it's anywhere between 1.5 and 2.5 million.
Okay, great. John, you, I know you've moved now from just property, we were a number of years, but you're a rental guarantee company, but you're more in the investing type market. And, but you also describe us what's actually happening in the rental market, per se, in South Africa. And, are there any particular trends that's happening that we should be aware of?
Well, yeah, I think the most important is that as an investor, you know that your investment is that secures your ability to collect on your rent. And after listening to Nikki this morning, I think that should be what's on everyone's mind.
That's where you You're working, yeah.
And I think if you look at recent statistics and look at the articles being written and some by some experts, you really need to revise who's managing your property and who's in charge of your portfolio, and ultimately what is their ability to collect your rent at the end of the day. Especially in the last few years where the focus has moved from just letting, that was basically a company that specialized in rental collection and management. Tables have now been turned to some extent where every estate agency out there give themselves out to be an expert in rental collections, and in fact they will do rentals as much as they will do sales to tap into that more sustainable income stream. And with that, unfortunately, the change is that a lot of real estate agencies do not have the correct systems and procedures that need to be followed while managing these portfolios, especially when the portfolio starts growing over 100, 150 properties. And therefore, also looking at what Nikki discussed this morning with the economy and how bad our economic situation is looking in the country, and the pressure under which consumers currently are, coincide with more defaults on the rental side. And that's obviously what Marion specializes in as a business. Before I go a little bit into that, just briefly level, which probably is the most significant for me, having sitting there listening to Nikki this morning, and what I hear is more and more risk. But yet, if you look at it, statistics show that where the average rental deposit in relation to your rent as a percentage of your rental that were taken 5 years ago was close on twice or 2 times the rental value. Now that has now dropped to about 1.3% of the rental value. So, and if you take it at 1.3%, it doesn't make sense that you will take a 1.3% rental as a deposit. So it tells me it's basically the deposit, and all that's happened is they've added the utility deposit on it, but they cease to take 2 months deposit on the rental alone. And to me, the significance of that is that in the good times, you were covering yourselves by 2 or twice the rental amount, whereas now that we're under more pressure, we're actually giving in to get to basically the point that the rental, now that you should be taking a higher deposit, you are taking a lower deposit. And that just tells me that, and that's where Marion is also currently seeing the opportunity in the deposit rate.
So what kind of defaults are you talking about? So if you're talking about defaults, what kind of defaults are you underwriting those defaults? How does it work?
Yeah, I mean, basically, what we see is that currently 33% of tenants either pay late or don't pay at all. When you drill it down, by often the first 2
in South Africa, is it
across the board?
Across South Africa, 33%.
It will either pay late, or when I mean late, it's if the rental agreement says on the 1st and they pay on the 5th or the 3rd, it's actually rent that's been paid late. Because by the time it's cleared your account and you've paid it over to your bond account, it might be the 5th or the 6th or the 7th of the month, so the bank's already written you a letter or given you a phone call and that sort of thing. So what Marion does, in essence, is we take the risk out of that in the sense that we guarantee a landlord that his rent is paid on the 1st of the month, or let's say the 1st working day of the month, which most of the time is the 1st of the month. So on the 1st of the month, we pay your rent into your account, whether the tenant paid or not. We then collect by debit order from the tenant in a rent.
Is that for life? You do that
as long as the contract is in existence.
Okay.
Should the tenant fail to pay, we will continue to pay you for as much as, or as many as 3 months consecutively on the 1st, whilst we take the legal responsibility of evicting the tenant or actually getting them to pay again and make an arrangement depending on the reason for the default. So we take that risk, and then once evicted, we will cover you to a deposit value for any damages on the property and so on. So basically that's what my...
Excellent. Thanks very much, Doc. Owen, I don't want to preempt your presentation, but you know something about the residential market. And you want to maybe give a little bit of a view of the South African scenario, residential market.
I think the crucial factor is that the consumer out there will be, as we were saying today, it's not a he, it's a she, but the typical consumer is a she. She will become more and more under pressure, financially speaking. Nikki spelled it out why. It's a combination of what's happening outside our borders and inside our borders. So once you accept that as a fact, and I'm accepting it as a fact, it's going to come our way, it's already happening, then you must ask yourself, what is the influence of this going to be on rental payments? Now, we've just heard that 30% are already paying late or defaulting on rent. I'm not sure if that is high or low. To me, it sounds intuitively that it's on the high side. So, the potential for upside, for growth in market rentals, therefore, must be on the low side. At one stage, there was an argument in South Africa about 5 years ago when house prices were very high, they're still very high, by the way, that because so many people are now, especially young entrants to the market, are forced to rent rather than to buy, as used to be the culture in South Africa, which still is the culture in South Africa, that therefore is going to boost market rentals of residential. And I've always argued that's not necessarily so, because the same factors that are putting pressure on buyers are also putting pressure on renters. So, and in fact, though, the past 5 years, we've seen that happening, and I'm going to show you the graph today, that rentals are growing at a rate well below the inflation rate in all the cities, even in Cape Town. And Cape Town is, from a residential point of view, a boom town at the moment. By the way, while we're on it, I might as well tell you the theory why it is so. I'll never forget when I started doing surveys or analysing house prices in South Africa, I immediately, right from the start, I classified houses in 3 price categories in those days, high, middle and low. Because I realised that, price could be very different depending on the price class you're talking about. And what we call the city bowl in Cape Town, which is places like Oranje, Zip, and Boersdorf, and at that stage, and we're now talking about the late 70s, I initially classified as low price because they were low priced. Lo and behold, I only started my company for a few years. On one evening, I was working overtime in my own company without extra pay. And I discovered to my surprise that at that stage, we're now talking about, say, 83, thereabouts. No, 85. No, sorry, I'm lying. It must be after 87. Let's say 88, 89. I discovered to my surprise that all of a sudden these city bowl suburbs had shot up, relatively speaking, and are now must be classified as high-priced suburbs. And I thought to myself, what on earth is happening here? All of a sudden, the city bowl became popular. And I worked out, that's my theory, is that, remember that the cycle of commodity prices peaked in 1980. Right? And remember, South Africa is a commodity exporter, as Nikki was explaining today. And where is most of our commodity-based companies based? They are on the Witwatersrand in Durban. And I remember when I was with Mitchell, in those days, I'm talking about the 70s, when somebody was transferred from Cape Town to Durban, we had to give him an extra house allowance because house prices were much higher in Durban. That is the hub of our economy. Of course, what happened is, as the commodity cycle turned, the local economy of the Witwatersrand was being economy is much more diversified. We don't really have commodities apart from agriculture. And that to me explains why Cape Town was at that stage doing better. And guess what? Cape Town is again doing better.
Thanks, Ewan. Bob, will you give us a little bit more of a global scenario of residential? Residential, there's a microphone. Oh, you do have a mic? Okay. Give us a little bit of a scenario, because, okay, first of all, you told us earlier on that obviously you choose commercial real estate above residential, but are there any sort of similarities maybe that's happening in South Africa that's maybe in Phoenix or in Florida or Atlanta or other markets outside, maybe New Zealand, Australia, that kind of stuff? Are there some trends similar, or are there some other counter trends happening out there, specifically in residential?
The trend around the world is that, I think the battery's down, the trend around the world is that in most of these countries the population is increasing, and that's where South Africa could be different. So you take the United States, for all the troubles we have in the United States, the population is still increasing. I remember as a kid when the population was 240 million, and now it's 320 million. That's 80 million extra people, and they're not all sleeping on park benches, so they're all accommodated. Some of the houses that are built to replace stock that's being destroyed through fire or earthquake, but that's a tiny, tiny percentage. Most of the new stock is pure new stock. So it's demand-based inflation. So you've got inflation of currency, which is really devaluation of currency, and then demand inflation caused by increasing population. The same goes for New Zealand. When I was a kid, population was 2.25 million, now it's 4 million. In Australia, I lived there in 1966, it was 12 million, now it's 21 million. So it's increasing at a massive rate. And, I don't know where your demand points are here in South Africa. The basis of the population that wants to live in a nice home, I don't think is increasing that fast, even though the overall population probably is. And the demand by a lot of people who want their first home or a first nice home is probably quite high, but it's at a much lower price. They're not in the Cape Town market, really. So the difference, I think, between here and many Western nations that are still growing, Asia is a point in case, is that there's huge demand inflation. That's why prices in Thailand and Hong Kong in particular, Hong Kong's been on this extreme rise for the last 30 years. But even Thailand and Taiwan and Korea and all that, massive, massive growth. Europe's different. Europe's got a challenge now. The population's increasing, largely because of these immigrants. I mean, Italy's had 200,000 people come in. It's a phenomenal number. They all have to be accommodated, and they're not contributing in the way that we would want them to, or that they want to as well. Other parts of Europe are in decline in terms of their traditional population, so it's causing mass disruption. Also, the concept of where people want to live is changing. The trend in the States now is to get rid of what we call the McMansion. How the name came about, I'm not sure. But it's this big 6 or 7 bedroom home. You have 5 kids, a bedroom for each of the kids, one for mum and dad, and a spare bedroom. And it's massive, and a 3-car garage or garage or whatever. And that's all going by the wayside. People are downsizing. And someone made the point, it was in the tech talk, that the way to make the world more sustainable and to stop rampant population increase is to make everyone more educated and more well-off. So it seems the more sophisticated we get in the West, the lower the birth rate, which has a decrease. And the extreme example of that is Japan, which has a current population of around 127 million. They think within one generation it's going to dip below 100 million. They've got an extraordinarily low birth rate. And they've got almost no immigration. It's probably the most homogeneous country on this planet in that regard. So is that good or bad for real estate prices? Well, it depends on whether you're a buyer or a seller. If you're a buyer, it's great because prices are coming down. So it's tough to know how to consider this because it depends on geography. And I would say, as an investor, if we can talk about that from, as a real estate investor, you could operate in any of those markets, even in Japan. Because in Japan, while the population in total is going down, there is a big mass exodus from all the rural areas and the other outlying areas into the Tokyo and Osaka region. So those places are still experiencing growth. So you can't just do the average thing. The idea in real estate is to beat the average. And there are 18 ways of beating the average that I can think of off the top of my head. You know, just to give an example, if you buy a piece of real estate by a body of water, the sea, a lake, or a river, it's going to go up in value, on average, much more than something not by such a body of water. You can pick any example. In Pretoria, by a lake, or in Cape Town, something on the coast is worth more, and it's gone up higher than something that's 500 meters inland from the coast. So it's a matter of picking a dozen of these ways of beating the average, and by combining a dozen, you get the, you know, what do you call it, the compound effect of all of them. And so that's how you play this game. And it works even in South Africa. I say that despite all the Nicky sentiment. But that's not to say that you're best off if you have, say, 100,000 units or whatever currency to deploy them here, rather than in Japan if you know how to find a good deal there, but more likely in the States or in Australia or in something.
On the question of where are the opportunities, at its very basic, you must look for areas, towns, municipalities where the supply is constrained for whatever reason. Because if the supply is not constrained, and I'll come back to that in my presentation, if the supply is not constrained, and assuming you've got enough entrepreneurs who's always looking for new sites to develop, then in the long run, prices will grow at more or less the pace of replacement costs, in other words, building costs. Of course, there are huge deviations from time to time, but that's the long-term trend. So the trick is look for areas. London, city of London is a good example. Big parts of California is also an example of that. Why? Well, no, it's because California has got very stringent urban edge legislation. So you're not allowed to develop beyond the urban edge. And Cape Town also has one in theory. It's one of the hobby horses of town planners nowadays. You know, you must densify your city, so you're not allowed to build beyond the edge. But nobody says to himself, that's all very well. I've got sympathy with the idea of densification, but do you guys realize what the practical implication is when you draw a line around the city and say, you bastards will not cross this line? It's got price implication. Over time, houses within that ring is going to become more expensive. It's a question of time.
If I can add, before I hand the mic over to you, Manhattan is a prime example. They drew a ring around that. It's called the Hudson River. They can't build beyond it. That's why prices have gone so sky high. The difference between Phoenix and Las Vegas is Phoenix has got almost no limits. It's 100 miles wide. We have streets that are like Camelback Road, I think it's 50 miles long in a straight line. You can drive for hours and still be in Phoenix. Whereas Las Vegas is very much, as you say, Lauren, it is constrained by BLM, a Bureau of Land Management land, and it's got an Indian reservation. It's very constrained. And it's just about full, and prices are already going up, but they're going to go exponential for the very reason you point out. It's be it an artificial constraint or a geographic constraint. When it's there, it's going to have a massive. So if you can identify that, that will be a precursor for increase. Also watch population trends. Where there's massive population increase, it is almost as sure as they follows like that you'll get price increases. Hence Japan's going down and other places where there's high population growth go up.
I just wanted to speak to a couple of points because we're seeing that as well. In certain markets, supply is certainly something that is important, but it's also what people are looking for. So you've got traditional suburbs, and I'm talking specifically about Johannesburg now. You've got the big house that you were talking about. The big house is no longer the trend, particularly the cost of energy has increased in South Africa so significantly that running a big household doesn't make sense. So you're finding people are actually spending more, substantially more per square meter for a different type of house than they currently have in traditional areas. And that's why traditional suburb sales have been flat at best, and you're seeing new areas that are really exploding and growing. But what's interesting is if you just look at the Durban market, that does create some opportunity for investors. And it's, as you said, you can probably make money in any market if you just find the opportunity. In Durban, if you look at flats and apartments, Almost 50% of them, they actually about 45% of them are below R1 million to buy, to purchase, and that price has been pretty much flat for the last 5 years. What that's meant is rentals that were traditionally much lower than the cost of ownership have grown in that same period, at least in those areas. So maybe not across the average nationally, but in those areas that I'm talking about, the rentals that you can achieve on those properties, the apartments in the popular Durban suburbs, is now well beyond the mortgage costs at least, if not the cost of ownership for those properties. And so the 10% odd growth that you saw in rentals over the last 5 years, matched with the flat capital growth, has meant that rentals are a great opportunity. If you want to buy apartments, they're still relatively cheap and affordable, and you can now get rentals that certainly cover the amounts that you would be outlaying on that property. So there's some cool opportunities in the midst of this flat cycle or down cycle.
Flat or apartment cycle?
Flat and apartments.
John, just tell us a little bit about the market that you're serving in terms of rentals. What sort of price category? Where's the demand? Where are the areas where there's a little bit of distress? When you've seen that 30-fold figure that you're talking, is it in the higher end or is it in the lower end? Just describe a little bit of the rental market, where demand is, and what kind of rentals are where the distressed areas are.
The average rental at the moment is in the region of about 6,700 rand a month, going up 7,000. That's at least what we see on the rental guarantee side.
So what's that, a 2-bed apartment, 50 square meters?
Yeah, it depends on your area. I mean, if you look at your more blue-collar area or whatever, you can get away with maybe even a 3-bedroom house for that price. It just depends on where you look at. In Shlanga, you'll get a studio apartment for 7,000-8,000 rand a month, 1 bedroom. So it just depends on where you look at. What we have picked up is that the higher risk tend to be the properties from 10,000 to 15,000 rand a month, and that's the people that you would expect won't, or are supposedly not a problem, that end up being a problem. And where you do, there's also areas like Simon was saying, where there's good investments, and that is for the savvy investor that look around and know what's going on in the industry. I know Alice Ross, what's it, Balale or whatever, with the mines and stuff, there's such a shortage of supply there that I know that you can buy a 1.5 million rand house and they will guarantee you a 18,000 rand a month rental return on it. So you can be cash positive from day one. So there is areas like that, but you need to know about it, you need to know where to look, and you've got to back yourself. In general, the default rate is going up, especially if you do not have, and that is probably the downfall of investor, the private landlord, which is the majority of landlords, and that's the guy that moves from Durban to Johannesburg, can't get a price for his house that he wants, so he ends up renting it out, and that's a huge portion of the market. And a lot of these people, because they are hard pressed to get a rental amount, they want to try and do it privately, which will then immediately put them at risk, like for instance with the CPA. Now you've got to have a CPA compliant lease agreement. Most private landlords don't know what CPA even means. They don't know where to do a credit check or how to do a credit check, and now they've got to do a credit check, an affordability check. So therefore you find that if you look around, a lot of them will advertise their properties themselves. I mean, Simon can elaborate on that, and they will try and be their own tenant, and they are the biggest portion of the market. And that is the portion of the market that we are actively looking at educating at the moment, is to say, mate, at least use of certain specialized services out there. For instance, like what we offer is a credit check, affordability check, and a proper CPA compliant lease agreement, so that down the line, if you have a problem, at least you've got something to fall back on. And most importantly, like I said, you have to make sure, rather take a month longer than to put someone in the property, than to put someone in the property that you can't get out, where they don't pay the rent. I think there was recently, we discussed it, there was recently a case where this guy was due, I don't know how, a couple of 100,000 rand in rental. His rental was like 40 or 45,000 rand a month, and it took them 6 or 8 months to get this person out of the property. So by putting someone in without a proper check, rather wait an extra month but make sure of the tenant than to take the chances to try and secure your income.
That's right. So parting shots, gentlemen. Sorry for you, Simon, on the just overview. I mean, of the opportunities. I mean, you're very optimistic guy.
Well, I sound optimistic, but I also got a bit of a shock looking at some of the challenges that we face in South Africa. But when it comes down to you as an individual, there are definitely opportunities around that you can find. You can beat the average for sure. I mean, those horror stories certainly exist, but some of the things that John was saying there make a lot of sense. You want to be looking at properties that are, lower capital value. The rentals are certainly higher versus the capital value of those properties. There are a heap load of tenants out there. I mean, we see that on the platform every day. Huge amounts of tenant interest, huge amount of demand. I mean, for every property listing that's on private property in the rentals I'm talking about, we've got between 50 and 100 tenants looking for those properties. So there is a massive, massive demand, and I think it's being fed and will be fed increasingly by the maybe the constraints on credit. So you'll find people that perhaps should have bought don't buy, and so that's going to be a good gain, I think, in the investment space if you can make the right decisions.
Go.
The worst thing you can do is not participate. You've got to turn up at events like this, and congratulations for being here, but go to other events, read books, not just mine, any books. There's no such thing as a bad book on real estate. Because if you spend, 200 Rand in 3 hours of your life reading one book, and you just get one idea out of it, that idea could be worth thousands a month to you. And then keep on looking. I agree with you. There are always deals to be had. You can always find an angle. You can beat the average somewhere. And if you get too concerned about what's happening here, then don't focus 100% of your effort here. Start looking in other regions of the world where you can do extraordinarily well. In fact, you might be astounded by what you find overseas. So just check it out. Use those smartphones in your computer. You can have a tour of the world in 5 minutes from the comfort of your own home. So there's no excuse not to do it. Watch less TV. I always say, if you want to improve your life, get rid of your TV.
Yeah, I'd like to give this more my last words, more of a contextual overview. So in South Africa at the moment, about 20% of people, of families, rent. In Germany, about 55%, in Switzerland, about 60%. I think what we are saying to one another is that there is a huge potential for renting in this country. I know you are battling against a culture, a long-standing, centuries-old culture of you've got to own. I've done the exercise, guys. If you compare the question of whether to rent or to own, the quick answer is that, and that's based on cash flow analysis, quick answer is that if you buy for cash, then it's all right to buy a house today. But then you must be realistic and don't expect growth, capital growth of more than the inflation rate. In fact, expect capital growth of half the inflation rate. That's my subjective view, based on pretty good research. If you are going to buy at a high LTV, loan to value mortgage bond, say 90%, boy, it's going to be one of the worst investments you've ever made. Given my forecast of capital growth, which is not going to be more than, say, 4% per annum for the next 5 years or so. I think it links in very nicely with what people like Nicky has been saying today. And I'll maybe expand a little bit on my own presentation. Right, so if you buy for cash and you select your area, you start off with a good initial yield. Let's say 7-8%, and there are still those around, I understand. Then if you add 2 to 3% capital growth, you end up with a total return of say 10%. And when inflation is 6%, guys, that is a total return you would expect in the long run from a property investment. About 4% your return, total return. Total return being income yield plus capital return. Fine.
Good news for you, John. More renters.
Yeah, from my side of the conclusion, I would just say that I feel for you. And why I'm saying that is I want to add again to what Nikki said this morning when she was talking about legislation and legislation around labour and how we deal with strikes and that sort of thing. That unfortunately, no matter how much you do your homework, government's always there to throw a curveball. And that's unfortunately something that you can't counter for. And if I can just bring up two in the recent years that had a serious and significant influence on the rental market is first of all when the Buy Act came into play, and all of a sudden you can't kick a defaulting tenant out of the property. That's a massive implication, guys. If you see some of the people we deal with, I mean, we've seen people, and especially elderly people, virtually being destroyed because they have people in a property that simply do not pay rent, and you can't get them out of there short of sending red ants in or some other ants. And then secondly, just in a recent article I read, that also put tremendous pressure on us from a rental guarantee point of view, and I don't actually even know how a private landlord, especially if you're an investor and you own multiple properties, and you can't handpick your tenants. If you can still handpick your tenants, it's that old saying that back in the day, that you look a guy in the eyes and you close a deal based on that. And that's one of probably the best ways of doing it. But when you start owning the portfolio, the golf and whatever, you can't do that. And last year, as you all know, April last year, they passed the credit amnesty, and with that it meant that your debt remained, but all your credit records were cleaned out, judgments were cleaned out, delinquent payers, if you were a slow payer, didn't pay at all, whatever, all that records by law had to be cleared by all the bureaus. So now I'm asking you, if you are not qualified to be that tenant, the risk you now take on, because even if you do have access to a credit bureau or whatever, you're going to come up with a clean report in any case. And that's what I'm saying, and that's something that overnight government decided that's a good idea, and for this and this reason we're going to implement it. And there's nothing we can do to counter it, there's nothing you can do to sort of prepare for it. And I think what I'm trying to say is this, that it is hard being an investor, and you've got to be on top of your game at all times, and you've got to allow for unforeseens. Otherwise, as much as you can really make a lot of money. To me, the best thing I've heard here in the town I sat here this morning was to listen to Scott and the guys and to Dolph and so on, and I thought to myself, is it not far safer rather to be a crowdfunder, even though to other people, than to really sit and do this myself? But that's just my 2 words. Thank you.
Okay, gentlemen, I want to say thank you very much. Just for the sake of time, obviously, so if you put your hands together for the panel. Thank you very much. Okay, so we're coming to our penultimate presentation, and it is Mr. Owen Roeder, and I think you know that he doesn't hold back on words and on markets and that kind of stuff. He has a very sort of callous way of describing things, which is good, because he's a realist. So without further ado, once again, put your hands together for Owen Roeder. Yes. Okay, just by the way, while he's busy miking up, the ASQS members, would you just please go to the net at the table? You do get, on your way out, okay, apparently you do get discounts when you do attend this event. Am I right there, the net? For ASQS members, so please, there's the net at the back. Thank you.
Right, I'm not going to dwell on the outside world, and Nikki did that. Suffice it to say, yes, that the world must deleverage, which means the world economy is going to grow very slowly for many, many years to come. That's exactly what Nikki was saying. She must have checked the facts with me. This can take a long time, right? I think, yeah, I don't think I'm going to see another boom. Right, so the medium-term prospects for the SA economy is I see lower growth in the wake of a low world growth and infrastructure constraint in South Africa. Nikki dealt with that, I'm not going to belabor it, including Eskom. So taxes and tariffs are set to rise to catch up with backlogs. She also mentioned it. One of the things being mentioned, being bandied around, is that the VAT rate will be upped to say like 20% or something like that. Maybe not in one go, but it's certainly on the cards. And until now, the government didn't have the political guts to do it. But we are now in a corner. The fiscus is in a corner, and let's hope Mr. Vinny's influence is strong enough to actually. So, but are you alert now, please? Before the rand tumbles even more and the VAT is out. Right, consumers are highly indebted and thus disposable income under pressure. Right, okay. Just to put that into perspective, that question of the fiscus is in a corner. Here's an example. Last year I did some research for, it was pro bono research, but now I'm using it. The total salary bill of the following metropolitan areas over that 10-year period, right? The 10 years ended 2013, grew at a compound growth rate of 14%. That is DA managed city guys, and it still grew even worse than the rest. Whereas inflation was only 6%. And that to me is a proxy for what's been happening in our public service over the past 10 years. Exactly what Nikki also points she made. So we've been indulging since 2008, especially to counter this recession. Government didn't spend on infrastructure, they spent on appointing civil servants and giving them fancy salary increases. So we've got a serious problem now also of expectations. This is the worst problem of everything, is the expectations that have been raised, that we are living in a cloud cuckoo land, that money grows on trees. Right, this is what Chris Hart, I don't know whether you know Chris Hart, economist, I've got a lot of respect for him. He says the credit-based consumption-led growth model has reached a dead end. So, right. So our forecast that I'm going to show you today is based on this baseline scenario. That's very similar to what Nikki showed us today. 1.4 last year, 1.5 this year, 1.9 next year, and then 2.3. You can see it's well below the 2.5. That is our maximum more or less in South Africa at the moment, given all the other states. Right. First, a lecture. I do it every year, and I'm not going to make any apologies for doing it every year, because I can't stress the importance of this long cycle enough. By the way, it's a matter of interest. Who of you were here last year? Okay, I hope you all have a bad memory. I mean, poor memory. But in the long run, I made that point a few minutes ago, in the long run, property prices are driven by replacement costs. And then around that replacement cost trend line, you have this oscillating prices or rentals, right? Now, this is a model that works in a free market where your supply is unconstrained and where your demand is unconstrained, right? Very important, the point I made a few minutes ago, your supply must be unconstrained. Then, in the long run, a portfolio of prime properties, rentals or values will more or less oscillate around that long-term trend line of replacement costs. If you take that oscillating rental, say office rentals, and you divide it by your long-term trend line of building costs, then you get your classic cycle, your real cycle. In other words, you say you deflate the prices, right? You take out inflation. Now note, in this idealized cycle, prices, when they reach that top end there and there, then what happens in practice? Supply rushes in because lots of money can now be made. So supply rushes in a free market and depress prices again, of course, through the balancing, the rebalancing of supply and demand. It's as simple as that. Yeah, so it can't go much above previous peaks. If it goes much above previous peaks, then you know the fall is going to be even worse, the coming fall. And here's the caveat, I've said it before, because of supply side constraints, this model does not work in London and the Atlantic seaboard in Cape Town. They doesn't make any more land, but the demand does go on growing. Right, and we've had other examples here today with Now, interestingly enough, the property market has something in common with the commodity cycle. The commodity cycle, there's a saying out there that what ends high prices is high prices, and what ends low prices is low prices. What is it saying between the lines? It says that when prices are high for a long time, what happens? Supply rushes in, and vice versa, right? And when prices are very low, then shafts are being closed down, and eventually you've got demand and supply equilibrium again. Right. Now, I'm not an expert on mining, but I understand it takes up to 10 years to open a new shaft. So you can imagine you've got a long cycle, the commodity cycle is very long. Similarly, the property market cycle is also very long. Why? Because once the property is being created and it stands there, unlike toilet paper, which vanishes after a week, it's gone, you've got to make new toilet paper. In the case of houses, say, or property, any fixed property, it stands there for 30 years, 40 years, maybe even longer in some countries. So once you've got an oversupply in the property market, it takes many years for demand and supply to get into equilibrium once you've got an oversupply, and vice versa. Right? It takes a long time to erect new buildings. So that explains the very long cycle we've got in property. Oh yes, I didn't make the point. The cycle is very long. That cycle is about 15 to 20 years, from there to there, and from there to there, and from there to there. It's about 15 to 20 years, very long cycle. It's got important implications for investment. I was listening to somebody here a few minutes ago. I'm not going to mention any names, maybe you'll recall it. The implication of what was said was that you can expect 10% per annum growth, if I heard correctly, of rentals. I know for a long time that was the sort of rule of thumb that was used by investors and by estate agents out there. Guys, there's no such a thing. And if there were, I'm sure there was a time when that was the case as a rule of thumb. That was in a time of high inflation. We are now in a completely new game. The rules of the game have changed. We are now in a post-boom era in the world, not just South Africa. Right. So in the UK, we also have a construction cycle of 15 to 20 years. And if you come to think of it, why would the construction cycle and building cycle and the property cycle, well, by construction is actually mean building cycle, right? We call it in South Africa building construction cycle. Why would they be similar? Well, what comes first is economy, then property, then building construction. So they should follow a similar pattern. And lo and behold, you find it also in the UK as an example. Right. Now here's what's happened in the real world in South Africa. More specifically, we are looking at the blue line is house prices nationally. After that, we take out inflation. And you see there's a long cycle there. Starting in 1966, that's our earliest data, but actually you can deduce that it actually started in 1960. Long cycle, and similarly office rentals after taking out inflation. We had a trough in 1960, trough in 1977, a small trough in 1994, 1995 thereabouts, and I don't know where the stuff is going to be, but it looks like if it wasn't for the economy that's so bad, of course this would have been the trough. It looks like things could get much worse. So that's our forecast. So if you're in a hurry, you can now leave. We are forecasting that house prices are going to decline in real terms, which is another way of saying that when inflation is going to be 6%, don't expect house prices to grow at more than, say, 3%. Right? That's just to give you an idea. In other words, in real terms, a decline. Similarly, in the case of office rentals, we expect it to move sideways in real terms, given the state of our world and South African economies. So, long cycle. What does it mean? If you buy there, and you buy there, if you buy there, you're basically guaranteed that it's going to be a very poor investment. And if you buy there, and buy there, and buy there, and buy there, well, your chances of making money and looking like a genius are much greater. So this is the problem with property, because we don't see the bigger picture. We so often buy by chance at the right time, and we think we are a genius and we now become a serious property investor, and vice versa. So guys, the trend is your friend. Do take cognizance of the bigger picture when you invest. Now, what does it tell us? The implication of this here is that offices and with it industrial properties are generally quite cheap in South Africa at the moment. And all we need is the economy to get better again. Right? And you'll have one hell of a boom in office rentals and therefore in office prices, and office values, and industrial prices and values. Of course, so we're all waiting for the doom. And whereas in the case of houses, I'm afraid that in real terms, house prices don't expect to grow much. In fact, it's going to decline. Just further evidence that we've got this long cycle. This is the cycle in private housing investment in South Africa. I get it from my friend Snyman. Snyman. Starting in 1946, you can see 1, 2, 3, 4 long cycles, very similar to the property cycle. Real house values starting in 1965, that's the furthest we can go back, that's ABSA data. You can see here the long-term trend line, that is building costs, grew at, the long-term trend line grew at 1% per annum in real terms, because this is deflated. It's a real SA house prices, right? So in real terms, we had only 1% growth per annum in the long-term trend line. Now, if you consider what I showed you previously, this model here. This implies you own a portfolio of prime properties that never gets secondary. In other words, it stays prime. How do you keep property portfolio prime? You continually do maintenance and upgrades, or you sell off the older buildings and you buy in new buildings. Right? So this model doesn't apply to an individual property. An individual property ages, like everything in this universe ages, even our stars and our sun. So an individual properties without major upgrades, as opposed to normal maintenance, will follow a trend line, not horizontally, but going down, down, down. Right. That's how property ages. It's amazing how many people won't believe that. Okay, most important thing, return. What is the typical return one can expect from property? What you're looking at here is historic returns of unlisted portfolios, in other words, directly held portfolios, of commercial and industrial properties. Now, this typically the sort of portfolios that mutual or someone used to hold in, ungeared. Very important, ungeared. You can see here that the total return for the first long cycle, which was from 62 to 77, actually that would have been 1960, but we didn't have data for 60 and 61. So it would have been 18 years rather than 16 years. The real return, the total real return was 4.8. Let's call it 5%. Now, total return, by the way, is income yield plus capital return, right? So if you buy a property at, say, 7%, and you get a capital return of 3%, 7 plus 3 gives you a total return of 10%, right? So in fact, this is the rule of thumb. You'll see the next long cycle, 19 years. Also 4%. So the rule of thumb internationally, not in South Africa only, that when you have a strategy, a so-called an Eve strategy of buy and hold. In other words, you buy a property and you hold it and do maintenance and so forth, but you don't do clever things like buying in an area where all of a sudden there now appears a sea next to you and you've got sea views and things like that. Then that is the sort of rule of thumb. In the long run, please, in the long run. Maybe not the next 5 years, but over a 15 to 20 year period. That's the sort of returns you can expect. last cycle, this one, in which we are now, which Germany is going to be much longer than 19 years. Something happened here. And all of a sudden, 7% real total return. You see, that is unnatural. It was a special boom period. It's not to be repeated again in our life. Well, not in my lifetime. Right? So many people grew up in the investment community thinking that that is normal. It's not normal. And we are being brought back to reality as we speak. Just for a matter of interest, how did listed funds perform? Well, taking that long cycle again, they did even much better. But of course, there they had the benefit of a structural decline in interest rates in South Africa and in the world, which then improved the rating of listed paper, and that of course gave us this extra boost, a real return of 14%, total return of 14%. We all know that that was the sector that it's one of the best sectors on the JSE over the past 10, 15 years. Right, a little bit more about the residential market. Flat returns, flat rentals in Durban. Now this is fascinating stuff. I'm comparing Durban average rentals with Durban central rentals, right? From 2005 onwards. It's indexed to 2005, it was 100. And note there that in fact, contrary to what you would have expected, Durban central rentals kept up with Durban decentralized rentals. Very important implication, guys. We all tend to be, because you're middle class people, oh, I don't want to invest in Durban Central or Durban Central, you know. I think you may be making a big mistake. There are huge opportunities out there, and what's more, you'll find your initial yield in those areas is much higher. Okay, maybe your expected capital appreciation will be lower, but your total return, because you started off with a high initial yield, might be pretty good. Well, the fact that rents are keeping up does imply that maybe your capital return might keep up also. Right, but as you all know, when you invest in that sort of market, it's crucial to select your tenants and to have iron fist when it comes to the management of that block. Right? Use biometrics, use all the modern aids to control people coming in and out and so on. And it's working. It's working in Pretoria. Sunnyside, exactly the same story. Sunnyside, which is the flatland of Pretoria, guys, over the past 20 years, they tell us exactly the same picture as you see here with Durban Central. It's actually keeping up with the rest of the geographic area of Pretoria. As opposed to what happened in Hillbrow in Johannesburg, where the guys did have proper management applied in the crucial 10 years up to 1995, and so you had the whole place becoming slow. But growth in national health